using those because they're not absolutes. There is a fair amount of wiggle room as to what you can do. And so once again, the general assumption is you try to be reasonably conservative with those assumptions so that the IRS doesn't call you out on them and potentially you have to pay big penalties. Okay? No, what question?
No.
Okay. All right. So assuming that we've got the improvements value, how much is our depreciation going to be each year? Well, that depends on whether or not it is residential versus commercial. Okay, for residential, we would take that 800,000 and we would divide it by 27.5. If it was commercial, we would take that 800,000 and divide it by 39. So here, I get 29,09091. Over here, I get 20,512.82. Okay, everybody match with me on that? Yes? Okay, what does that number represent?
The annual depreciation.
Yes, represents the annual depreciation that you would be able to claim on the property. That would be the line item, if you will, here for the depreciation amount. Does that make sense? Yes or no? You would be able to put 29,09091 if it's residential, and 20,512.82. So basically, almost $9,000 difference or $8,500 difference between the two per year. Okay, does that make sense? Yep.
Where would that go on the?
Right here.
Okay, depreciation.
Is that a straight line method? Yes.
Yes, but no. Good response, Monica. Okay. For real estate, we have a straight line depreciation method for beyond the year of purchase, or as the IRS puts it, beyond when the property is placed into service. Okay? For other assets, like vehicles, computer equipment, and other things, you have what is referred to as the Modified Accelerated Cost Recovery System, MACRS, okay? Which basically what happens there is you write off the overwhelming majority of the value basically in the first couple of years of the asset, and then it has a lower and lower sort of residual value from that point forward, okay? Has everybody ever heard of that before? Okay, some of you yes, some of you no, okay? Now, with assets, and this is what I said, much more stuff to blow your mind, with assets that are not real estate, you have what is referred to in the year of purchase as the mid-year convention. You're saying, huh? Okay. For tax purposes, the IRS says that regardless of what time during the year you bought the asset, this is not real estate, this is other assets, that you get only 1/2 of a year or 6 months of depreciation for that first year. Now you're saying, huh? Why? And then why do we care? Okay, this is going to become relevant about what we're about to talk about with real estate. So, just as an example, if they're basically saying you've got a non-real estate asset that maybe is worth $100,000, and they're saying that maybe the depreciation schedule is you get to write off 30% of the value of that, which would be $30,000 potentially in year one, okay? And they say, well, it's a mid-month, or I'm sorry, a mid-year convention. Then what they're basically saying is that you're only going to get to write off basically half of that in that first year. And you're saying, well, why? For basically bookkeeping purposes. Because the assumption is you're going to be buying all sorts of assets throughout the year. You're going to be buying cars, you're going to be buying computers, you're going to be buying all sorts of equipment throughout the year. And so to simplify things, the IRS thought it would be a great idea to say, all right, since you're buying stuff throughout the year, we want to simplify your tax schedule a little bit. And so we're going to just automatically make the assumption if you bought it during the year, you get 6 months worth of depreciation instead of the full year, okay? Now, what does that mean? Well, remember what I said earlier about people basically responding and reacting and influenced by tax law? What do you see happen in many organizations whenever it comes to the purchase of equipment? They wait until the end of the year to do it. What is the reason why? Tax purposes. Because if they buy it at the end of their fiscal year, they get a full 6 months worth of depreciation on that asset. That's huge. It's money in the bank. Okay? So, that is kind of the motivation, and that's what happens. Well, with real estate, the IRS said, hey, real estate's a much bigger asset, a lot more money, so we're going to assume there's better bookkeeping and tracking and that sort of thing with real estate assets. So instead of a mid-year convention, you have a mid-month convention. So, regardless of when the asset is placed into service, the assumption is it's placed into service on the 15th of the month. So if you bought the real estate on January the 1st of the year, when would the IRS assume it's placed into service? January the 15th, my birthday. Okay? January the 15th, by placing it into service on January the 15th, even though you bought it on January the 1st, that's really whenever you did place it into service, but the IRS is saying you're placing it into service on the 15th, how many months of depreciation is that for the first year?
11 and a half.
11 and a half. So you don't get the full year's worth of depreciation in that first year, regardless of when you purchase it. The most you're going to get in the first year is 11 and a half months worth of depreciation. Does everybody understand that? Yes or no? Now, what if you place it into service December 31st? How much depreciation do you get for that first year?
14 days.
Basically 15 days. You get a half a month of depreciation, okay, for that first year. Does that make sense? So, in other words, this is really important. So we'll write it down just so that it makes sense. If it's placed into service anytime during the month of January, you get 11 and a half months. February, 10 and a half months. Let's just put them all out here. March, April, May, June, July, August, September, October, November, December. Hopefully I didn't leave out one. All right, so 9 and a half, 8 and a half, 7 and a half, 6 and a half, 5 and a half, 4 and a half, 3 and a half, 2 and a half, 1 and a half, and oops, half.
This is December 1st, January 1st.
Yep. So any time it's placed into service during that month, that's the number of months of depreciation you have for that first year. So just to throw out one, because I'm prone to do this sort of thing. What if you bought the asset today? Okay, what is today's date? May the 20th. So we look to the month of May, right here. So if we bought it today, we would get 7.5 months of depreciation. Does that make sense? Yes or no?
Yes.
7.5, okay.
Okay.
Regardless of the date.
Regardless of the day, it's all about the month.
Oh, okay.
Well, it's called the mid-month convention because the assumption is, regardless of when you buy it during the month, it's placed into service on the 15th of the month or the middle of the month. So you get half a month worth of depreciation. Now you can say, well, some months have 30 days, some have 31, some have 28, some have 29 in leap year. Okay, they simply just say half a month or not half a month.
And 30-day basis, you
30-day basis.
What is that, place in service? I mean, what is that term, like, you buy
Good
it
question.
and
Okay, normally, it is when you purchase the property. But you can make the argument that you're not going to start generating depreciation until the property is available for occupancy. Because that's when it starts being used, or that is when it is placed into service, okay? Now, as the owner of the property, I will tell you, your motivation most of the time is to do what? Place it into service the moment you buy it, because that's just that much more depreciation you get. Does that make sense? Okay, but the IRS might say, well, you bought this property, it was raw land, you built a building on it, it took you 6 months to find a tenant for the building, so they're probably going to argue, if they audit you, the place in service date is going to be the one where the tenant takes occupancy. Does that make sense? Okay. But you could argue, well, I've turned on the utilities, I've started paying, you know, all of these other sort of fees and charges even without the tenant being there, yada, yada, yada. You might be able to make the argument, but I'm just saying, place into service is technically whenever it initially goes into service. Now, another interesting factoid about this. The clock on depreciation starts with each new owner. This is, once again, one of those things, tax world versus real world. So this is what I'm telling you. Listen to me. I bought a property, let's say, 10 years ago. I had gotten 10 years of depreciation off of that property. Regardless of whether it was, once again, residential, commercial, I've gotten 10 years of depreciation. I sell it to you tomorrow. All of a sudden, the clock starts over again. You now have either 27.5 years or 39 years of depreciation. Okay? You sell it after 5 years to her. Clock starts over for her. Perpetually, the clock starts over for each new owner. And you're saying, is that realistic? No. It's the tax world. Okay? Because the assumption behind the tax world is that every time that transaction takes place, that supposedly the property has been made ready for, you know, sort of a new life of sorts, to begin anew. Okay, does that make sense? All right?
Can you depreciate by, essentially, if you purchase the land, like we're saying, pushing some dirt around, and having images of your dirt being moved around?
You can try a lot of things. All I'm saying to you is that at the end of the day, if the IRS audits, they're going to have their own sort of interpretation of what's reasonable.
Involved here that's been pushing dirt around for a long time.
And that's very possible. It's very possible. Okay, moving forward. All right, so let's do a couple of little calculations here, just to sort of illustrate my point with this. So we said that our property had $800,000 of depreciable value, and we had said that, oops, back up here. All right, and we had said that for residential, 27.5 years, it was, what was the dollar amount? 091, rounded or somewhere in there? Okay. So assuming it's placed into service in January, what would be its value? Or depreciable, what would be the depreciable amount? So what you're going to do, the math involved in this, let me just kind of help you out here, is you're basically going to take this and you're going to multiply it by like 11.5 divided by 12 to get, if it's placed into service in January. Okay, you're saying it's placed into service for 11.5 months out of 12. Okay, so you're going to get whatever that percentage is and multiply it by the 29,000. Does that make sense? Okay? So to do the math, 11.5 divided by 12 mathematically is 9583. Everybody follow?
What do you mean by place and service?
Okay. Placed into service is whenever the asset is starting to be used. Once you've purchased it, once it's placed into service means once it's starting to be used.
What if it's sold?
Okay, when is it sold? How soon after purchase did you sell it?
No, I bought the land, I built a complex or a house.
Okay, then if you bought the land and then you don't get to depreciate the land, so the time period where the land is empty, no depreciation. Whenever the house or the building is built, once that building is built, then technically that's when it goes into service.
But can't you not depreciate for sale product?
Yeah, no, yes, that's true. Yeah, but for sale product, that's a whole different side of the tax law. I'm talking about, once again, you're strictly building it, owning it, okay, or acquiring it. Yeah, for sale, that's a whole different kettle of fish we're not going to get into.
So if it's yours, you mean when you start using it?
Correct.
Or if it's for
Well,
rent, when
okay,
for the-
this is only for investment property. This is not for owner-occupied property. Only for investor property. Okay, so in this case, what you're doing is taking the 29,091 and multiplying it by the 0.9583. And so that means if it was placed into service in January, you would get 27,878, 879 rounded for the depreciation for placing it into service in January. Does that make sense?
That's mid-month.
Mid-month convention. If it's placed into service another month, then you would have to obviously apply that month. So like for example, if we place it in the month here in May, then the calculation would be 29,091 times 7.5 divided by 12, which would be 0.625. Or we would only get 18,181, 182 rounded. Okay? And that would be, once again, if it was placed into service here in May. Okay? Make sense? Nice warm fuzzy feelings? Okay.
So in that scenario, you would want to buy the property in January
To maximize the depreciation for that first year.
Okay.
And when you ask for residential, you will say multifamily. I mean, you will be very precise.
Yes, I will. Okay. Moving forward. All right. So, let's do a couple of other sort of calculations here. So remember this little sort of what I refer to as the tax subroutine. Remember what that was? Net operating income minus interest expense minus depreciation gives us taxable
income.
multiplied by the tax rate gives us our income taxes payable. Okay? So, assume that I just simply tell you, okay, you've got net operating income of $100,000, and we said for this particular property, if it was placed into service today, how much was the depreciation that we just said for the mid-month convention for May? What did I say it was? 18? Okay, 181 or 188?
182.
Okay, 182. All right.
So forget that the depreciable amount in what side of the balance sheet would be? On the liability side or the asset?
Well, okay, the asset is the overall asset value. The liability is that, yes, you're going to have depreciation that you're going to,
So liability would replace it, right?
in essence. Okay, now, okay, in this particular case, just for the purposes of our calculation, we're going to, let's go ahead and make the assumption, okay, we've got a loan, all right? And we need to figure out specifically what is the interest payment for the loan. So let's go back here for a moment. Let's make some very simple assumptions. We're going to assume we have $1 million loan. So that's going to be our present value. And I'm going to try to make this realistic, but not overly complicated. We're going to make it 12 payments per year to be realistic, and we're going to have, let's say, a 10% interest rate on the loan, and we're going to have a 25-year term, and we're going to calculate a monthly payment. Okay. Oops. 9,087, and then basically no one payment, something like that. Okay, so that's our monthly payment. Our annual payment, will be multiplying that by 12. Of course it is a big. Okay, let's lower the interest rate because I don't want it to be above 100,000. Let's lower the interest rate to 5%. Sorry, but you're going to like me better if I do it this way. Okay.
So what was the thing?
Okay, well, all I'm doing is changing the interest rate on the loan from 10% to 5% because the payment's too high to work out for our little problem here. Okay, so $1 million, 5% interest rate, 25 years. Monthly payment is 58, 45, 90. Annual payment, there we go, 70,000, 150, 80. So, all right. So 70,000, 150 is going to be our annual debt service. Okay, that is the total amount of principal and interest on our mortgage. Is everybody comfortable with that? Now, what we have to do is we have to figure out how much interest did we pay on this loan for that first year, okay? Now, let's assume, while we may have bought the property at the beginning of the year and we placed it into service in the middle of the year, we actually had a loan on it the whole year. Okay? Now, once again, this would be an assumption that we would provide. But in other words, it kind of gets back to the whole thing. We bought it for $1 million, we made some improvements in it, it took us a while to get it leased up, and so we really didn't place it into service until May, but we've had the loan on it for the full year, so 12 months worth of payments. So now, to find out what the interest piece of this is, we would go as follows on the calculator. 1, input, 12, shift, amortize, to get basically our payments in terms of principal, interest, and the balance, and you would hit the equal key, okay? Now, once you do this, let me show you what happens.
And we still have it set up at 12, right?
Still have it set up as 12. But yet this is telling us what is going to be our principal, interest, and our balance for the first 12 months.
Do we leave everything, do we have to clear or do we have
No,
to
leave everything in there.
Okay.
Wait, say it one more time. That's not how you.
Okay, let me put the numbers down first and then let me answer the question. Okay. So the first one is going to be the principal portion, which is $20,619.07. We hit equal again. We get the interest portion, which is $49,500. 531.74, and we hit equal again to get our balance of 979 and 381 roughly. Okay, the number, principal, interest, balance. Okay, the number that we are concerned with for the purposes of this calculation is the interest piece. Okay, how much in total interest do we pay during that first 12 months? All right, this is going to be the number that we're going to place over here. So 49, 531, 532, we'll say rounded. Okay? Does everybody follow that? Okay? So all we have done is we've used the calculator to compute our monthly payment, get our annual payment total, annual debt service, and then to figure out how much of that annual payment is allocated to principal and interest. But the only piece of that we need is just the interest piece. Now, what you will notice, what happens if you add the principal plus the interest? Well, let's do the rough math. 20 plus 50 is what?
We got the annual debt
70.
service.
Yeah, exactly. All this is doing is separating it out, okay? And the only reason we're separating it out is for tax purposes, just to figure out how much of a deduction that we get for that interest expense, okay? Now, once we've got that, now we subtract out both of those from the net operating income. And you get 32,286 as our excuse me, taxable income. All right, now I would have to give you the appropriate tax rate. As I said earlier, the one we're going to use most commonly is going to be 28%. You're saying, where does that number come from? Once again, the IRS provides that, okay? And we're going to have different tax rates for different types of income, which we're going to get to, not today, but you're going to have one tax rate for what is referred to as ordinary income. You're going to have another tax rate for what's referred to as recapture depreciation, and you're going to have another tax rate for capital gains. Basically, three different ways that you're going to be taxed, or three different rates you're going to be taxed on real estate. Okay, so doing the math, 32,286 times 0.28. So our taxes payable for this year are going to be basically $9,040.
So you're going to give us the tax rate on.
Yes,
And this is assuming when you put 1 into 12, it's just as the first year,
correct,
right? Okay.
correct.
And the tax rate you give us, it'll be the combined tax rate, not just.
It will be the marginal tax rate. Okay? Okay. Moving forward. All right. Is everything making sense so far, for the most part? Okay? All right. Now, let's see. Moving forward. Make sure I'm covering everything here. So I'll leave you in a lurch. Okay, so another thing okay, in addition to depreciation of the building, you also typically get to depreciate or amortize points. Okay? One of the things that whenever you get a mortgage loan, you may pay what are called discount points or loan origination fees or loan origination points. And these are a dollar amount usually based upon a percentage of the overall value of the loan. So, as an example, if we have a $1 million loan and our points are based on 3%, so the discount points are based on 3%, the loan origination fees are based 3% of the loan amount, then that would be $30,000 of points.
So that's to calculate just points?
I'm sorry?
That's to calculate, we're working on points, just to calculate points.
Just points, okay? Now, the IRS does not allow you to fully deduct those points at the time of purchase. They require you to amortize them or allocate them over the life of the loan, okay? Well, in this particular instance, what is the life of our loan that we were playing around with? 25 years. So what that means is we would take the points paid up front, divide by the 25-year loan term, so 30,000 divided by 25 years would be $1,200 per year that we would get to amortize or allocate each year for those points. So now here's the thing. Let's be clear. When do we pay the points?
Up front.
In other words, when do we write the check for the points? At the closing, when we buy the property. But the IRS is simply saying, no, 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 you don't get to deduct those when they're actually paid. The benefit of those points is really over the life of the loan. Okay? Well, what if you pay off the loan early? Then you get to reclaim all the points at the time you pay off whatever is remaining. Like if you paid off after 5 years, then you would get to claim the remainder of the residual of whatever's left over.
So basically, you always said that your points are 3%. So you have 30,000 that you will discount for the 30 years, right? I mean, for the loan.
Just for the loan,
25.
just for the loan term.
For the 25 years.
Yes.
But if you sell the land, whatever, and you do it in 25, then you will divide the 30, divided by 5, or no?
If you sold it after 5 years,
Yeah, no.
what would happen is this would be just as follow. It would be like this. Year 1 is going to be 1,200. Year 2, 1,200. Year 3, 1,200. Year 4, 1,200. And then year 5, you would get the 1,200 if you sold it at the end of year 5, and then you would get whatever is left over out of the 30,000.
Oh, okay.
So basically, you take 1,200 times 5, that's 6,000. So basically, that would mean 24,000 at the end of year 5. Okay? Make sense? Okay? All right. Okay. Let's talk about capital gain.
So, Professor Ford, before we go to the capital gain, where did the points come from? I didn't listen to that.
3%.
Okay, once again, whenever you get a mortgage loan, typically the lender is going to charge you a fee for that mortgage loan. That fee normally is called a loan origination fee or points, okay? And so that fee is something that you pay up front at the time the loan is originated, in this case, $30,000 that you write a check to the lender for that entire amount.
Okay, and depending on the contract clause, you may get the reimbursement if you sell before year 25th, right?
Correct.
Okay.
Okay. All right. Shifting gears, next topic, capital gain. Very simply put, the capital gain on a property is whenever you sell the property for more than what you have paid for it. Simple as that. So you buy a property for $1 million, let's say. You sell it however many years later for $1.5 million. What is your capital gain?
500.
Your capital gain will be 500,000. Does that make sense, everybody? Yes or no? Okay, that's simple. But of course, we're going to make it complex. Okay? So, very simply put, there is a tax rate associated with capital gains. Okay? And the tax rate that may be associated with that depends on how long you've held it and a whole number of other little things, but it could be 15 or 20%. Okay? Let's just say it's 20%. So what that means is the capital gains tax rate is 20%, 500,000 times 0.20, that means you would pay $100,000 in income taxes on the sale of that property. Does that make sense? Okay? On the capital gains portion of the sale. Okay?
So $100,000 is my portion of the taxes that I will have to pay.
Yes. You bought it for $1 million, you sold it for $1.5 million, your capital gain is $500,000, the capital gain tax rate is 20.20, 20%, meaning that your tax payable on the capital gains is $100,000. Okay? Everybody cool with that? Yes or no?
Yes.
Okay. Now is the part that you're going to hate me for, if you don't already hate me. Okay.
This is where you save the money.
All right. Recapture depreciation. Yes. Okay.
Do you
Recapture.
carve these things?
I'm sorry.
You carve them?
What do we have? Okay. The way you should, before we get into this, the way you should think about the quizzes, you shouldn't expect to get 100% or anywhere close to 100% on the quizzes. The quizzes, in my mind, it's like doing homework. That's the way you should look at the quiz. If you've done a good job, you've taken good notes, and you really understand what's going on, then yeah, you're gonna instantly do well in the quiz. Okay, that's the idea. But if this is the first time you've ever seen any of this is the first time you've ever thought about any of this, you're going to bomb the quiz. That is normal. That is natural. Okay?
But will you laugh at us when we fail, Professor?
No. But what happens is now you take that failure and you say, oh, okay, I see what I did wrong, I see what I didn't understand, and you're able to go into the test and you're able to blow the test out of the water and make a near perfect score because you've already seen it, quite frankly, by the virtue of seeing the quiz. Okay? It's a way of forcing you, in one sense, to do your homework in class. Okay? And then you obviously are better prepared whenever it comes time for the actual test. And then if you still don't quite get it on the test, then you get the final exam to basically study that much more and to get yourself prepared. Okay? But you know what the content's going to be because you've already seen it. Okay? All right. Moving on. Recapture depreciation. Okay. In this particular example, we were saying we sold the property for $1.5 million. We had bought the property for $1 million. Okay? And we said that was a capital gain of $500,000, which is going to be taxed at 20%. Okay? Yes. Okay? So that's going to be taxed at 20%. Now, whenever we bought this property, we said the property, the depreciable basis in the property was $800,000. Okay? Now, after 5 years of owning this property, it has depreciated. That portion has depreciated. Yes?
Yes.
Okay. Now, assuming this is residential, all right? Let's divide that by 27.5.
It's 2909.
Okay. So we get 29 091. Now, 5 years,
See, I'm sorry, I can't see. What is that?
okay, all we're doing is repeating what we've done previously, which is to say we have the residential property, $800,000 divided by 27.5 years gives us 29091.
Right, but the five.
No, it says it's residential.
Residential.
No.
Okay, this is just simply stating what we've got right here on the board. This is exactly what's written here. Okay? All right. So the 29091 is the annual depreciation, okay, for the property. So really, what we're saying is over 5 years, this property has depreciated by $145,454.54, okay? So that is what we're going to call accumulated depreciation after 5 years, okay? Now, technically, if we want to be accurate about this,
You're gonna give us the 5 year, you're gonna tell, how do you give us 5 years? Sorry, that's the holding period?
we're saying that's the holding period, okay? So over 5 years, you're going to have $145,484 of accumulated depreciation. Now, technically, for those of you that are really paying attention or honed in on this, it's really not going to be that full amount, is it?
No.
No, 'cause
Why?
you're gonna have a month.
Because we have that first year that we only get, what, about $18,000 worth of depreciation, right? Okay, so what we really should do, in order, if you're being completely accurate in this, then we should probably say, well, all right, it's really more like 29091 times 4 years of full depreciation, and then get that number, and then add that to the half a year, or whatever the May depreciation of the 18,000, what was it?
18,182.
18,182, and then that would be our combined total accumulated depreciation. Okay, does that make sense? So now, so erase all of that, and let's try to simplify it just a little bit.
Where in the book is that, Professor?
Can I try to get through this, please? Okay?
If it's not in chapter 11, you should not be in the tree. That's
Oh,
why-
it's also what I'm covering in lecture. Not everything that I cover, not everything that's covered on the quiz
No,
is
Professor,
covered in the
but
book.
no, it doesn't make any sense to choose one example and then have a quiz. That's not fair.
Yes, it
I'm
is.
sorry. No.
Well, that's the way that I run my class, okay? Okay, now, so once we've got the once we've got, in this case, the 500,000 of the capital gain, then what we're saying is that we have $145,000 of accumulated depreciation after 5 years. So what we're basically saying is that $145,454 of accumulated depreciation, whenever we sell the property, that is going to be taxed at the recaptured depreciation tax rate of 25%. Okay? So we're going to multiply that by 25%.
So we just used the 5 years.
I just used the 5 years to simplify for the purposes of our calculations. Okay? All right? So 36,364 rounded would be the tax on the recaptured depreciation. Okay? So what we're saying is that for this particular property, this is what we're sort of trying to end with here, is you're going to be taxed on the capital gain, and then you're also going to be taxed on this recapture depreciation. And we say, well, why are you being taxed on this recapture depreciation? You're being taxed on the recapture depreciation because the IRS has said, we have given you this tax benefit for the past 5 years of your ownership, and because you're selling it for more than what you have paid for it, and more than its depreciated value, we're going to reclaim that from you and tax you on that. Okay? Yes?
So basically, you do the depreciation, you know, for the 5 years or whatever time, but then that 25% you will give us, you will set recapture depreciation of 25, or where do we assume that number from, the 25?
So you're going to be given that.
Okay,
Okay?
That's called the
recapture.
Recapture depreciation tax rate.
And that only happens in the year that you sell it.
That is correct.
Okay.
Okay? All right.
Don't erase that yet, sorry. List them first.
Okay. Sorry, what was?
Brain is done.
That's soon?
Your brain's done.
Okay, we got 5 more minutes, and I've got only one more topic, so we're almost there. Right on schedule.
Just one. Right.
Early this week. Huh?
So your question would be, what is the tax rate going
Right.
Yep.
Just in the 5 years, so if we buy the property in the first year, you will get the percentage 6.5,
That
7.5,
18,000, whatever.
whatever. But in the next following year, you will get the whole year, right?
Correct.
Okay.
Correct. Okay.
Was that a break?
Yeah, I think so.
Only
The whole first year, and then the next.
What about all the expenses?
12, 11, 10, like that.
What do you mean all the expenses?
The expenditures to reduce the capital gain.
That is in a future class. Okay? Right now, we're just covering the basics. Okay. All right. Now, the final piece for today is as follows, which is actually a review, okay? Which is to calculate, in essence, the before-tax internal rate of return and the after-tax internal rate of return. All right? So, in essence, one payment per year, okay? And so let's say that we've got the following cash flows of $2,550,000 as our initial cash outflow or our purchase price. Okay? And our income, $213,350, $211,656, $210,937, $254,675, and then in the final year, we sell the property and our final cash flow gets added in, $4,290,389. All right? So those are all our before-tax cash flows for the property. Okay? So this is identical to, obviously, other problems that we have done up to this point, and you're simply being asked now to calculate the internal rate of return for this set of cash flows. All right? So in doing that, what you're going to find is you're going to end up with 17.11. This is an example directly out of the book, okay, on page 373. Okay, so this is the set of cash flows for the property on a before-tax basis. Okay, before-tax cash flow or before-tax internal rate of return. Okay, everybody follow that? Yes? Now, also in your book, oops, okay, also in your book, right below that is the after-tax set of calculations, okay? And in this particular case, the after-tax cash flow calculations are taking that same $2,550,000 acquisition price as a cash flow, taking the 165,705, 164, 348, 159, 894, 183, 920, and then finally 3,849,654. All of those.
What 59, 894?
Yep, it's also in your book. Page, what did I say? The top of page 373. You're going to do this one payment per year.
And that's after tax.
And this is your after-tax set of cash flows. So all of these are after-tax cash flows. So whenever you solve for internal rate of return, and once again, this is all review from last week, in this case, in terms of the calculation piece of it, what you're going to get is the answer they provide to you there, which is 13.38%. Okay? Now, this is the final piece of the lesson, and we're done. Okay? Take a look at our rate of return for before tax and compare it to after tax. Okay? What you see is that if we are the investor in this project on a before tax basis, our return is 17.11%. Yes?
Right.
Our return on an after tax basis is less. Why is it less? Very simple word. Taxes. We paid our taxes. Okay? Now, this is the final piece of this, of the puzzle. What is our implied tax rate as a result of that? Okay? After everything is taken into account, whenever we've calculated these two numbers, the before tax internal rate of return and the after tax internal rate of return, where the rubber really hits the road is we want to know, what are we really paying as a tax rate on our income? It's a very simple calculation that you do by hand, and it is simply going to be 1 minus your before tax internal rate of return over your after tax internal rate of return. Okay? So in this case, if we just sort of put it out there, our before tax,
17.
oh, my bad. Sorry about that. It's just the opposite. Getting tired just like you. Yeah.
So it's
It's after tax over before tax. Okay? So the after tax number is the 0.1338. The before tax number is 0.1711. All right?
Are you going to give us the after tax cash flow
This
numbers?
is the same as subtracting and dividing by the first one? It's the same, right?
Potentially, but just this is a simple way of doing it. Okay? 0.1338 divided by 0.1711, and that's going to give us 0.7819. So you're simply going to take 1 minus 0.7819, and you're going to get 0.218 or 21.8%. That is your effective tax rate. So what we're simply saying is that for this investment, that is your effective tax rate. Does that make sense, everybody? Yes or no?
Yes.
Okay, all right. So now it's time for the quiz. Quizzes.
a question for you. If they're gonna give you this example, and how do you know when they just tell you calculate the PT or the AT? And you're just gonna have the start
Okay,
flow?
once again, I have gone over what is on the quiz, okay? And you should be able to take a look at the information. And as a, and to answer your question specifically, page 370, page 371.
Yes.
You were asking earlier what pages was I covering, and that was the pages. Okay. All right. This is not here. Let's see. Okay. Well, let me get your new answer sheet. Lewis, where do you go?
As long as they have a healthy curve. Do all that.
Okay.
Hell
Your brain, bro.
All right. All right, here is quiz number 2.
Right.